Okay, here he is.
Test, test, test. Got me?
Yes, good to hear your voice, Rick. How are you?
Sorry, sorry for my Luddite tendencies.
It's okay. All's well that ends well. Look, it's a pleasure to have you, and I'm always just absolutely amazed by your energy and your willingness to do interviews and share your knowledge. It's truly impressive.
I've learned, first of all, I've learned that I wasn't uh, built for retirement. It would appear that my brain needs to be either sedated or stimulated, and working is healthier for me than drinking. So, thank you for saving me from drink.
That's a good way to look at it. Keeping the brain active and not being bored is a positive thing. And that's what I told my mom. I said, Mom, just keep moving. Just keep moving, keep thinking, and good things will happen, or at least bad things won't happen. Look, y- are you going to write a book? It seems like a natural thing for you to do now would be to write a book or two.
I'm not going to. What I'm doing is I have a free educational site called the Rural Classroom, and I've thus far recorded, I think, 9 half-hour long discussions that is part of an already outlined 60-part series, and that'll be my book. I should have written a book as a younger person. They're great business cards, but I don't need a business card anymore. What I would like to do is leave 30 hours of course material in video about investing in natural resources, and that will be my book. I've learned that people absorb even written information better if the author speaks it, which is to say, audiobooks seem to have deeper comprehension for people than reading, particularly author read books where you get their cadence and diction. And I believe that video ultimately will have better comprehension even than audio. So I'm, sort of 15% of the way through a 60-part, 30-hour series on rural investment media around natural resource investing, and that will be my book.
Okay, very good. Yeah, that's something I need to dig into. Um, Look, I'd like to have deeper conversations, with you because I think, you can handle them and you're a good person to have them with. So I'm going to ask you a couple of deeper questions. Time frame and the mismatch of time frame is a problem for a lot of investors. And Rick, you can just mute yourself while I'm speaking, and then I'll do the same when you're speaking. It helps to not have background sound for the listeners. Bottom left is the mic button. You can just hit that. Um, so the mismatch of time frames is a real problem for a lot of investors, especially junior mining speculators. And what I mean by the mismatch is someone might buy a junior mining stock, an explorer, and they might have a thesis on a particular project. And, for this thesis to play out and for it to be proven right or wrong is most likely going to take a minimum of 2 or 3 years. It's going to take several drill programs. It's not going to occur in 1 month. Okay, let's put it that way. Um, but very often, I speak to people who will buy a junior mining stock. They love the project, they like the management team, they like the name of the company. And then a month later, they say, Robert, it's down 10% or 15%. I'm getting worried. They haven't published assay results yet. I said, it's 30 days, like, come on, this takes time. You can't have a time frame of 30 days in this business. And I see this over and over again, where a lot of investors are swayed by a tweet they might read by somebody they think is smart on X, or they read something on co.ca, and they just get motivated to sell, or they get motivated to buy, but they're swayed easily. And so what would you say to an investor like that who might have encountered this problem in the past?
Well, I think your observation is absolutely correct, first of all. You may know that I've graded almost 100,000 natural resource portfolios in 35 years. And I've learned an awful lot about investor and speculator behavior. In the first instance, strategically, many of these people are fairly good. They invest in a thesis like deferral of sustaining capital investment in oil and gas or copper, or uh, the printing of excess currency or debt and deficits. But these strategies can easily require 5 years to come to fruition. And if somebody makes an investment based on a set of circumstances that will require 5 years for them to realize their return, but their tactics prevent them from holding stock over a long weekend, that mismatch of intention and time frame is critical. The second is probably more important, and that's what you talked about. I mean, the first miracle of investing is the miracle of compounding, and that takes time. And it isn't just money that compounds, but rather knowledge compounds too. So, as an example, in uh, mine development, mine construction may easily take 3 years, and then it takes another year for the mine, once constructed, to kick in. It is the increased certainty of increased free cash flow that causes share prices to go up. So, to the extent that somebody invests in a company, either in the exploration business or in the development business or even in the producing business, it's important that when you buy a stock, your reason to buy the stock is apparent to you, and that your time frame corresponds with the time you allocated holding the stock. I get over that by every time I buy a stock, I write myself a little one-page handwritten memo that talks about what my thesis is, that talks about what my target is, that talks about what might go wrong, and talks about what would cause me to sell the stock, either in terms of the pricing levels around the attainment of my goals, or around what operational failure would look like. It is having that understanding that allows me to hold stocks for the time period necessary to enjoy success. It also forces me, by reviewing these memos to myself, to cut my losers. If the reason to own a stock goes away, the stock must go away, irrespective of its price level. And so your question is very prescient, and it's one that's fairly easy for investors to address if they're self-honest.
And I notice that, I mean, I'll just talk about myself, because that's the best person I can talk about. When I buy a stock on a whim, I might read a news release and say, "Oh, hold on, yeah, this looks like they might be onto something," but I don't dig into it deep. I just read it for 20 minutes, 30 minutes. I think about it for a little bit. I might ask another investor a question about it, and then I buy it. So I'm not doing a deep dive. I'm buying it on a bit of a whim. Then I'm more easily swayed to sell it on a whim because I haven't done the work. What would you say about that?
Uh, I would say that in that case, speculating is a hobby, and there are probably better hobbies for you. Uh, that becomes a very expensive hobby, buying stocks on whims. There are probably things, I have hobbies. I like to go to museums, I like to read, and those hobbies are cheaper than speculation as a hobby. Um, I, I hope I've addressed that. Buying buying stocks on a whim can be dangerous financially. It also, in terms of monitoring your portfolio, distracts you from focusing on names that you know well enough to make money. So I would encourage you, if you still do that, not to. I'm uh, I certainly don't get every speculation right, but I have a fairly rigorous process by which I speculate. And in particular, because I understand what would cause me to sell a stock, and because I've identified why I think the stock might go up, but what is necessary to cause the stock to go up, I'm pretty good at not letting 25 or 30% losses turn into 70 or 80% losses. I redeploy both the capital and my own mind span away from positions where I certainly won't make any money to those where I stand a good chance of making money. It took me about 10 years to learn to do that, but mercifully, I'm an old guy, so that happened a long time ago.
Yeah, I think that's well said. I think sometimes I get a little bit arrogant and I think, well, I know well and I can, understand something in 30 minutes and I could do that. And then I always remind myself, no, I'm actually not that good. I actually need to do the work on these. And it does take away from the attention and I think that the bandwidth, and that's the most important capital that we have. So buying things on whims and adding them to your portfolio when you don't really understand them deeply, it's taking away from your bandwidth, and that's costly, both in terms of financial capital and in terms of attention capital. You said something earlier about how it kind of brought my mind to how the returns on an investment um, are not linear, right? So you might hold a stock and it goes nowhere for 8 months, and then in 2 weeks it might double. And if you didn't have the staying power to see that double, then you really, missed out, right? And I see this all the time that investors write, "Oh, I'm bored with this stock. It's not going where I'm bored with this stock." And then in 2025, we had many examples of stocks that doubled or tripled or quadrupled in very short periods of time. And so, by being bored and getting out of it, they really cost themselves some big returns. And I think, one example that comes to mind is Scotty on the TSX Venture. Scott is the symbol, and that was very boring for quite a while, and then it more than doubled in a very short period of time. Um, I what would you say about the time frame that investors have to have, and the ability to stay put to receive the profits and the fruits of their investments?
The ability to stay put, I think, comes from knowledge. Confidence comes from knowledge. Um, People pay slavish attention to the price of their stocks, but the price is really useless information if you don't have an opinion as to value. Money is made on the delta between price and price and expected value. That's how money's made. So, although the price information is easy to get, it's useless unless you have an opinion as to value. And in speculative stocks, it isn't just today's value, but probabilistic values in the future. If you, as an example, believe that if a certain set of circumstances occurs, let's say that you identify a stock right now that's selling for $1, and you think the assets in the company could be liquidated for 50 cents. That means in the near term, your potential downside is half. But you determine too that if the right set of circumstances with the management team and the assets on hand, uh, if the answering of unanswered questions follows a progression that you think at least there's a strong possibility of, that the stock within 18 months could be worth $2 and the stock within 5 years could be worth $10, and you have a sort of a framework in your mind for how that could occur, you become much more rational and much more patient. If you don't have any target for the stock, but rather if the only frame of reference that you have is the price, then it's highly likely that if the price either goes nowhere or goes down, you get shaken out of a stock. Let me expand on that. In terms of speculations, I back tested my own portfolio performance, or rather, an intern back tested my own portfolio performance going back 40 years. And in particular, we tested the performance of stocks where I had enjoyed a tenfold or better return, 1,000% or better return. And there were some wonderful shared characteristics. 1,000% gains, or better yet, 10,000% gains, required between 5 and 6 years on average to occur. Tenfold gains don't occur over long weekends, although tenfold gains are responsible, in my case, for most of portfolio performance. A stranger thing was that the average tenfold return exposed me to, over 5 years, at least one, but often two, 50% share price declines, which means that in addition to being patient, you have to be persistent. If you have an opinion as to the value of the stock, what happens is that precipitous share price declines become for you buying opportunities rather than occasions to sell in panic. And I would say what has set my own performance apart from most speculators is that recognition that money is made on the juxtaposition between price and expected value, and that one needs a continuing value model, and one needs to act on the sell side uh, in the context of the discrepancy between price and value. If the value doesn't change, but the share price falls by half, that isn't an excuse to sell. It's a clarion call to buy. Similarly, in a bull market like today, where you are buying stock in anticipation of the value creation that comes from the answering of an unanswered question, but the market is generous enough to give you the share price that you had anticipated without the question having been answered. I mean, we're seeing circumstances now where I'll own a stock because I think that an upcoming drill program will validate the data from surface work. And I think that at the conclusion of the drilling program, that I may get a triple on a stock. But what's happening right now is that the anticipation of the result is causing stocks to double or triple before the drilling campaign takes place. In those cases, I always sell enough stock that I have my capital off the table. I don't have to wait for the answer to the unanswered question to accomplish my goal, and I will always sell. If I own a stock and the data from the drill campaign suggests that my anticipated outcome is going to be disappointing, I will sell the stock too. If the reason to own a stock goes away, the stock must go away. No ifs, ands, or buts. And making that determination uh, means necessarily that you have an opinion about the company's value and an opinion about the company's expected value. If you don't, frankly, you're my normal and natural victim in the space.
So you've gone through so many portfolios and had so many conversations with investors, speculators, call them what you will. I'm interested to see what you would add to this list. So the mistakes that, in my experience, most investors slash speculators make in financial markets are they trade too much, they trade too often, they're hyperactive, they're too short-term focused, they're too easily swayed, they bet too big, so they put too much capital into one stock, and they're not willing to process new information that's contrary to their existing bias. What would you add to those?
That's a really good list. And before I add to them, let me talk about them. Trade excessively is an extraordinarily big problem. You pay too much tax. you pay too many transaction costs, and you don't have time to focus on individual companies. Fidelity, the great big mutual fund group, did a study where they looked at their entire investor universe, which is millions of people over time, and they found that the best performing subgroup of investors among all the Fidelity investors were dead people. They were estates, accounts that didn't trade. Dead people outperformed every other subgroup in the Fidelity universe because they didn't chase fad, they didn't trade. Time frame, we talked about that before. The great miracle of investment return is compounding. Warren Buffett said that he didn't make anywhere near as much money by thinking as he did by sitting, simply sitting. If it worked for Buffett, it works for you. Allocation, taking an outsized bet, a bet larger than the one that you can either financially or psychologically afford to make, is critical. And bias is similarly critical. I would add at least two more. One is relevance. A deposit, if you're in the natural resource investment business, the deposit target has to be large. The idea that you can develop a small high grade deposit and then use the cash flow from that deposit to grow without issuing shares is seductive to entrepreneurs, and it almost never works. Anything that can go wrong with a big mine can go wrong with a small mine, but a small mine can only make you small money. Taking big risks for small rewards, while seductive, is stupid. The second thing that I would add to your list is people, specific people. What you learn in speculating is that you must be an elitist. There's a social science dictum called Pareto's Law, which is the social science explanation for the folk wisdom around the 80-20 rule, the fact that 20% of the population generates 80% of the utility. There's two important parts of Pareto's Law to know. First of all, it's a bell-shaped curve. So 120% of the population generates 80% of the utility in any given function. A different 20% of the population generates 80% of the aggravation in any given activity. So your first job as a speculator is to identify and hang out with the good 20 and avoid the bad 20 like the plague. What becomes more important over time is that if you take either the good or bad lip and you run it through the same performance dispersal curve, the data conformably aligns at least two more times, which is to say that 20% of the 20 does 80% of the 80, and or 4% of the population roughly generates 65% of the popular utility. And if you run it through a third performance dispersal curve, what you learn is that about 1% of the population base generates between 40 and 45% of the utility. What that means in terms of speculation is that if you develop a sense of history in the space that you're investing in, you learn to identify the 1% of the population that generates 40 to 45% of the returns. If you just hang out with them, you will work half or a quarter as hard as you otherwise would, and you'll make twice as much money. Hanging out in the mining business with the guys I call the living legends, the Robert Friedlands, the Lundin families, the Bob Quartermains, the Ross Beatties. Forget the great unwashed. Never mind, forget about the jerks, the guys who are serially unsuccessful and serial frauds. Even forget about the middle, the so-called great unwashed. I know it sounds ridiculously elitist, but that's the way the world works. And when you have identified a performer, make sure that the performer today is engaged at a task, that the task at hand is similar to the task that he or she succeeded at in the past, which is to say, if the identified success was the fact that the entrepreneur operated and turned around a producing gold mine in Archean terrain in French-speaking Quebec, but the task at hand is exploring rather than operating. Let's say a porphyry copper gold in 15 million year old accreted volcanics in Spanish speaking Peru. Although both activities are mining, the success isn't related to the task at hand at all. So I would add to your list a track record of success at the task at hand. And to the extent that you're willing to do the work, it isn't just the major ego, which is to say, it isn't just the largest shareholder or the chairman or the CEO. That person has to, in order to minimize your risk, has to have assembled a board of directors who is chosen for their own experience, which is relevant to the task at hand. Their VP exploration, as an example, should be very familiar with the rock sequence that they're exploring. Their CFO needs to be experienced in mine building, if that's the task, or money raising, if that's the task. The disconnect between the resumes of the people who are managing your money and the task for which they have been chosen is a major reason for failure among speculators.
Yeah, and that brings me to Ivanhoe Electric. I just recall that fell to $4.50 a share in early April, and now it's $15 a share. And Ivanhoe Mines had that problem with the seismic activity in June. It fell to 8.76, and now it's $14 a share. So buying the stocks of the great ones when they're really beaten down and oversold is also a pretty good investment strategy over the long term. Not 100%, but pretty good batting average. Uh,
I would suggest it's important in that. By the way, I agree with you. Um, what happens is that market panics take down the good, the bad, and the ugly. And when that happens, you got to concentrate on the good. I would suggest, however, that you understand the reason for the share price decline. I own an awful lot of mines, an awful lot. I've sold enough that I have no net basis in it, and I've sold enough that I paid the capital gains on the stock that I paid to eliminate my basis. The the seismic event is one that isn't well enough understood that the stock is riskless. If that seismic event has to do with ceiling caving, that's one thing. If it has to do with column crush, that's an entirely different thing. So it's important. I mean, you got the big thing right around Ivanhoe. If 15 years ago, when the stock was selling for 63 cents and it had 97 cents a share cash in it, and it was headed by Robert Friedland, and they had two tier one discoveries, you bought the stock. If you forgot about South Africa, you forgot about Congo and bought the stock. The response today is much more nuanced, but it's important to get the big things right consistently. Uh,
yeah,
a,
yeah.
a different example might be when Equinox went uh, behind schedule and way, way, way over budget at Hard Rock in Ontario, when $1 billion budget turned into $1.6 billion or $1.8 billion, and a 2.5 year build turned into a 3.5 year build, and the stock fell by half. What you needed to do was try to figure out from your own viewpoint if the track record of the mining team meant that uh, this was going to be a failed effort or a seriously hurt effort, or if the decline in the share price more than compensated for the fact that the market was disappointed with time and budget. If you made the latter decision based on the management team and based on Ross Beatty's adult supervision, what you did is you greatly increased your position in the stock, and you watched as a consequence of an eventual successful effort that stock triple.
Yeah, that is a good example, and that's a very relevant to the current time, with Equinox really getting its groove back here at the end of 2025. Look, I want to ask you a little bit of a tricky question. I've had many occasions in my time in the junior mining sector where, I saw a piece of news hit, or I caught wind of a rumor that something might happen, and I had felt like I had a very high probability that I knew a particular stock was going to rise over the next 2 weeks or 3 weeks or 4 weeks, but I didn't really like the company, right? So I didn't want to be an investor. I didn't really want to align with this particular management team, but I had a pretty high probability that something might go up. And maybe some examples would be like government of Canada chose a company to be reviewed for mine permitting fast track, and that was going to be all over the news for a few days. Or maybe a company published core visuals, and the core looked pretty good, and it was going to get everybody excited. And I would probably have an opportunity to sell before the assays came out. So my question to you is, if you ever see these circumstances arise where you see there's a high probability this stock is probably going to rise in the short term, it might be good for a trade, but you don't like the company or the stock, do you take the trade?
No, no, I'm mercifully these days, and by these days I mean for the last 40 years, I'm completely unblemished by fear of missing out. If the stock doesn't meet my criterion, I don't care. The most common circumstance for me is I'll be monitoring news releases and I see a nothing, nowhere, frankly, bullshit company that's entered into $600,000 in, financial public relations expenditures with various influencers. But what makes a stock go up in the near term is more buyers than sellers, right? So it's entirely likely that this $600,000 will be spent enticing 1,000 mullets into the stock. I don't care. I just don't care. Uh, that isn't the way I buy stocks. It isn't the reason I buy stocks. Frankly, being attracted to a bunch of people who think that their role in life is to swindle butchers, bakers, and candlestick makers, it's just not a group of people I want to hang out with.
Very good. So turning to the bigger cycle, so the precious metal cycle, and where we're at in gold and silver, where would you say we are at with the precious metals? And then a follow-up to that, where would you say we're in the junior mining bull market?
Let me begin by saying I don't know. Uh, so let's get that one out of the way. My own behavior is being driven by the belief that gold prices primarily are set with fear of maintenance of the purchasing power by savers and investors in fiat currency denominated savings products, but particularly the US dollar. That allows me to begin to model market response. I believe that because of debt and deficits, and also because of increasing pricing levels I see rising much faster than the CPI. That while, as an example, the U.S. 10-year Treasury is trading at basically a 4.2 handle, the deterioration in the purchasing power is achieving, from my point of view, about an 8 handle, which is to say real interest rates are decidedly negative. I also believe that this condition persists. I think as a consequence of debt and deficits, that the US dollar will lose about 75% of its absolute purchasing power over 10 years. If this is true, I think it's not unlikely, not certain, but not unlikely, that the nominal price of gold, which is to say the US dollar price of gold, over that period, over the next 10 years, increases to roughly mirror the decline in the purchasing power of the US dollar. So a nominal gold price increase of between 250 and 400% seems likely to me over 10 years. History teaches us that in prolonged bull markets, the 1970 to 1980 bull market, the 2000 to 2011 bull market, or the much shorter 1990 to 1996 bull market, in those circumstances, a basket of gold stocks, a relevant index, increases in price at about twice the rate of increase of the gold price. Those are all very, very, very rough numbers. If that's true, over the next 10 years, and perhaps on a shorter basis, I think that we still have fairly dramatic increases in the gold market and the gold stock market. Um, so I guess I'll leave the answer there. What you notice is that various types of stocks, categories of stocks, outperform others at other parts of the market. This bull market, the bull market that we're in, saw market leadership change from the best of the best all the way down to the exploration stocks, which is to say the tertiary stocks, at a much more rapid rate than I have ever seen previously. And I saw between 8 weeks ago and 10 weeks ago a market response for the juniors uh, that I thought was giving the sector too much too fast. The consequence of that is that I personally sold 25% of my junior portfolio, despite the fact that I think it's more likely than not that we have 10 years or so of bull market in front of us. I did it because I was able, by selling 25% of my portfolio, to recoup my entire investment in the junior sector, as well as generate enough cash to pay the capital gains tax. I was able to sell off 25% of my upside and eliminate my downside. For the proceeds from the sale, I took half the proceeds and I bought gold beta, which is to say I bought physical gold, and I bought a basket of Franco Nevada, Wheaton Precious, and Agnico Eagle. I traded off alpha, which I felt was overvalued, for beta, which I found was undervalued. I took the other half of the money and I went in the oil and gas sector, which I think is roundly undervalued. So your response to the set of circumstances that you see has to be geared to your own perceptions, I think, in order for you have to have a strategy to work your strategies. I guess what I'm trying to say.
Yeah, I have a feeling that you're moving more money than most of the people on this space when you're talking about selling a quarter and moving it
Well,
into.
that part's true. I was able to do that because I had a very low basis relative to the market value of stocks. I had to do it because in at least three names, I had some concentration, which is to say, I owned a fairly substantial part of the float. And when you're in that circumstance, the time to sell some is when you can. You have to take advantage of volume.
Yeah, and I think that's an important one. You made several important points there. I think the last one I'll just talk about for a second, and that also explains why in some of these juniors, when a company quote unquote puts out good news, everybody's saying, "Oh, it's great news," and then the stock gaps higher, and then it just gets sold down for 3 hours. Well, a big holder is using the trading volume to get out because it gives them an opportunity to actually sell. They've been waiting to sell for 6 months or a year. So a lot of you people who post on co.ca, why is the stock down? It's great news. Well, you kind of got your answer. And that will apply to a lot of those situations, especially on a day when the company publishes a news release. Rick, I want to ask you kind of a more, this is a little more complex of a question. Um, so for example, let's say I have a friend who's a big silver bug, a big silver investor, and back in September, he was making money almost every day, and he was telling me all about it. Oh, I'm up 50,000 today, Robert. I'm up 40,000 today, Robert. I said, "That's great. That's great." And but as September went on, I said, hey, you might want to sell a little. You might want to take 100K off or 200K off. It's not going to hurt. Robert, silver's going to $100. Why would I want to sell now? And I said, well, it doesn't go to 100 in a straight line, Jim. It might have a correction at some point, and these stocks can drop really far, really fast. He said, no, it's going to 100. I'm not selling. And then, a month later, he ended up panicking and selling a bunch of stock on almost the exact low of that little pullback in silver because he got freaked out. And that's why I said, look, you need to think about it differently. Selling into strength after a 2 or 3 week run and taking a portion of your positions off is not a bad idea. It's just risk management. And this is something that a lot of people don't seem to get. So, maybe you can explain why, an investor who really does see silver going to $100 still might want to take some profits in the shorter term after a big run.
30, 40 years ago, I used to manage markets for some guys. And if I had some shareholders that had big positions and I had volume, I'd call them up and say, I want you to take some money off the table now. I can help you off right now. I might not be able to help you off in 5 or 6 weeks, and I don't want you to freak out and have to sell. It's important in the absence of the company managing a market that you manage your own that you manage your own emotion, you manage your own need. Imagine that you're Eric Sprott. You talk about some stocks that sell flat on news. Imagine you're Eric Sprott, and that there's 30 stocks in your portfolio where you own more than 10% of the company, sometimes 30% of the company. Um, there will come a time when you aren't able to come off 30% of a company. You are just not able to come off that stock. You have to trade when there's volume. You have no second choice, even though you believe with 80% certainty that the stock is going higher. You can't make the decision based on your opinion of that market in its entirety. You have to make your action based on your own wants, your own needs, and how the stock fits into your portfolio. It's critical that you do that.
Okay. And then I think final question, unless I come up with one while you're answering this one, and maybe we'll take a question or two from the audience. A little bit different subject matter, but I think this is interesting, and I'm kind of curious to hear what you say. In the mining sector, why do the big companies, the Newmonts, the Rio Tintos of the world, the big majors, why do they not really focus on early stage stuff? Why don't they do exploration more in-house? You would think they would have good geos and a lot of data and they could do all this work on their own, right? Like, why do they farm it out to the juniors, the way they do in the sector?
The investment community no longer pays majors for exploration efficiency because there's uncertain outcome around time. They get paid enterprise value relative to free cash flow and projected free cash flow out over the discount period, which is to say 8 years or less. It is more efficient for the major to overpay for successful efforts than it is to penalize earnings by doing front end exploration. The other less pleasant truth is that the junior companies as a whole cost of capital is lower. If you merged every junior company in the world into one company, Junior Explorco, that company would lose in aggregate somewhere between $2 and $10 billion a year, which is to say that the junior industry as a whole is perpetually overpriced. Its cost of capital is sub-zero. The majors can't compete with a sub-zero cost of capital, but they can easily afford to overpay for a successful discovery. And that explains it all in a nutshell. The other thing, however, in terms of the prospect generators, as an example, juniors who joint venture exploration with majors, it costs the major if they come into a new market. Let's say that Centerra is going to move into Mexico. It costs them $1.5 million to set up the effort to do it before they spend a dime in exploration. If they do an exploration joint venture with a prospect generator that's already set up in Mexico, they save that $1.5 million. And if they do part of it on the balance sheet with the junior, with the prospect generator, In the event of an unsuccessful outcome, at least they can sell the stock in the junior and recoup some of their capital. So the decision being made by the majors right now is effectively outsourcing. And outsourcing is occurring in every intellectual capital business on the planet. It's simply good business.
We'll take a question, maybe two from the audience. So if you'd like to speak, a request, and I'll activate your mic. While we wait for the audience, Rick, one more question for me that I thought of. I have a feeling that at some point in 2026, the junior mining sector, the precious metals, might go on a really, really nice run at some point in the year. And some people on this call that will hear this in the future might be feeling a lot of greed at that moment in time at some point during that run, and they might feel like they're missing out. They might feel like, man, everybody's making money around me, I'm not making enough money, and it might tempt them to make a really bad choice. What would you advise them to do?
Again, success in speculation is all about the juxtaposition of price to value. If you have an opinion as to value, then the price will determine what you do. If the price moves too far relative to the value, you sell. If the price moves down too rapidly with regards to value, you buy. Price information is absolutely meaningless without an opinion as to value. If you aren't capable of forming an opinion as to value, go do something sensible with your time and money.
Leonidas, you have the floor to ask Rick a question. You need to unmute yourself, bottom left. Go for it. Oh, he got stage fright. Does anybody else have a question for Rick? We got 4 minutes.
Well, while we're on this, if I might tell people, if they care about my opinion as to these topics, they can personalize it. If they go to ruralinvestmentmedia.com and list their natural resource stocks, I personally will rank them 1 to 10, 1 being best, 10 being worst, and offer comment on individual issues if I think my comments have any value. That's ruralinvestmentmedia.com. Please no crypto, please no pot stocks, please no tech stocks. Ruralinvestmentmedia.com. I'll rank your portfolios, your natural resource portfolios.
We have another speaker that came up. Go ahead. Hani, Hanney.
Hello, yeah. Sorry, I've only just joined. I don't know if you've got onto like oil and stuff. I know Rick is quite optimistic on the oil price. Is that, are we just doing metals or any
No, you
commodity?
can ask him anything you want.
Yeah. So Rick, I'm in the UK. Unfortunately, as you see with everything that's going on, we've got obviously a massive tier one North Sea asset, and Labour in the UK is doing everything they can to obviously ruin that industry. There's obviously a lot of value where it is and some great operating companies. I know you kind of favor US and Canada. Is that more for what you see coming, or kind of more of your core competency, or where you have expertise, or what do you think about the North Sea companies that, yeah, that are,
I
I don't think it's really worse.
I agree with your outlook, which is to say that the politics in Great Britain are trumping uh, the geological outlook for the British North Sea. If politics weren't part of it, the incredible infrastructure that you have in the North Sea would allow the British industry to do what the Norwegian industry is doing and exploring fairly aggressively with the view that they could leverage off existing infrastructure. Unfortunately, that doesn't seem to be the case in Great Britain. For me, what I found is that there is so much value in the top end of the space, which is to say, names like ExxonMobil, that I don't need to go down the value creation chain very much. When I benchmark companies, risk versus reward, including all levels of risk, what I find when I benchmark most companies about Exxon is I buy more Exxon. I'm not trying to optimize my portfolio. I'm trying to optimize the juxtaposition between risk and reward.
Okay, we have another.
Amazing.
Thank you. Another.
Actually,
Oh,
I've got to go. I've got to be somewhere else
oh,
in a minute.
okay.
And as you saw with my technical acumen, it takes me a while to get there.
Rick, thank you very much. This will be up on YouTube the next couple of days, and also the link for the Rule Symposium will be available. Thank you, everybody, for joining. Cheers.
Thank you.